Everyone, we're back on live stream, and the audio is working today. The audio is working. We actually had some nice people in the comment section come to the rescue of James, and it is very possible that a promotion is in order in the future to a senior technical advisor. You guys have to let me know if you think we should give that to James. That title. Titles are everything in this world, and if you don't have a cool title, what are you even doing? So that's, I think that's the next character arc for who you are. We might promote you to internal creative director one day, but we have to take baby steps.
Okay, fair enough. We were just dogging on the acronyms yesterday, but I'm sure STA, that could be a new one. That's okay. The STA.
Yeah, I think there's a lot of, well, it is bring your dog to work day too, right?
That's right. There he is. See him?
You guys can see in the background Klaus, the legendary little, what kind of dog is he again?
He's a dachshund. Let me do a little dog review. Hey, there he is. What do you have to say, bud? Oh, these interest rates are too high. Okay. He's the man. That's why. What are you gonna get a dog? You got a dog?
I always have one of my friends who tries to pitch me on getting a dog, and the thing is, he actually trains dogs for a living, for like the police and military, and so if I bought one, or like police, military, and celebrities, and he's sold dogs for like up to $200,000 that are like trained, because like celebrities will be like, oh, well, I can't bring like a gun to the airport, but I can bring my dog. So there's this entire thing, or to other countries, right? And like it is wild, like some of these dogs, how obedient they are. I was like talking with him, and he was just like, oh yeah, he's like, they'll do whatever you like. If you literally like give them the command to jump off a cliff, they'll just go and do it. They're just like the most obedient dogs on like planet Earth, because they train them that way, right? Because especially with the military and police and everything, like, so I'd consider getting one of those, but I just think, guys, if
the door has opened, the door is ajar now. I feel like a couple years ago, guys, he said absolutely not, no way.
well, here's the thing. My baseline is absolutely not. If you're trying to accomplish anything in the world, the last thing that you should have is like probably an animal that you have to come home to every single day and like make sure that it's still going, and you can't go out, you can't go do this, that, like whatever, man. I'm not getting
for all the times you go out. That's right.
Sometimes I have to go travel places here and there,
That's true.
All right. Well, guys, welcome back to Capital Flow's live stream. The focus for today's live stream is on US equities, because that is something that people focus on so much. We're also going to talk about Bitcoin a little bit. As a quick just reminder for the intro and for everything that we're doing, every single thing we're doing every day is built for risk takers. That's the entire goal. And to be able to understand the entire macro regime and be on the same side of it, and to find asymmetric bets that function as home run trades. And so the entire first section will always be free for the macro playbook, where we cover the big picture. And then if you want to really connect those to everything that is tangibly taking place across price action, the specific trades, live Q&A, the positioning report that I send out every night, and then also the models for capital flows, those are all reserved for paid subscribers on the Substack. There's been several trades that we've been talking about specifically. I talked a little bit about the yen one that we've been running, has been printing, and that's been going well. There's always updates that you need every single day, though. So that's why we're doing this live stream every single day. So on the topic for today, Yeah, so if you guys want to, be on the paid section, it'll be on the second half of this stream. So the place that I want to start for today's stream, and the thing that I think about the most right now, is this chart. And there we go. So why am I pulling up this chart? Why are we going to talk about the risks in equities today? And here's the qualification that I will start with. We're going to talk about macro. We're going to talk about valuations. We're going to talk about credit risk. We're going to talk about duration risk. But here is what I would say. Valuations increasing or decreasing are connected to macro liquidity. That's all they're connected to. Any broad-based rise in risk assets that's correlated, and it's not just, one asset rising or one sector rising, but when it's the broad market, that when its valuation function expands, it is, fundamentally always connected to the valuation and liquidity component in markets. If you quantify this, it's actually not that complicated. And I'll actually pull this up for you just so you can have a better idea of the quantification of it. When you quantify, well, how much in the market is from valuations and how much is from growth or earnings or all of the other things that are taking place, those things are not difficult to do. There's a lot of different ways that you can do it. And I'm trying to pull up this chart right here. But this chart that I have up right now is of the valuation bands for the S&P 500. So this is not the price band. This is not Bollinger Bands. These are showing overvaluation and undervaluation. So again, not price bands, but valuation for the price to sales ratio. And the PE ratio is basically the same. Right now, we are at one of the highest valuations we've ever seen over the last decade and actually in history. Now, again, when you hear that, don't viscerally react to think, oh, well, that has to be bad. We have to have a crash soon. Not the case. The thing that causes crashes are asset liability mismatches when positioning is too aggressive. And when you actually look at the underlying factors, you will notice right here is a breakdown. Let me actually pull this back just a little bit so you can kind of see more of the marginal change of it. Right here. So you can see here valuation expansion versus earnings expectations in the S&P 500. And, earnings versus realize have, basically increased pretty significantly. If you see earnings expectations, they've only increased. Realized, there's a decent spread between expectations and realize. We're coming out of earnings season now, which has all been, fairly positive, nothing crazy. But notice, and I'm going to zoom in for you so you can get a closer look at these specific things right here. Notice that the majority of moves that we have seen over the last 2 years, some of them have been connected to the earnings function, but a lot of them have been connected to, and the majority of them connected to what? Valuations. And this is the rolling return, so it's not just the outright returns, but it's not just the outright index, but it's the rolling returns. And what you can see is that especially year to date, the majority of changes we have seen have been valuation expansion. Even on the downside, this is one of the reasons why I got, long and added exposure during the pullback earlier this year. It was all valuation contraction. It wasn't earnings changing. And the connection to that is that valuations are driven by macro liquidity. Macro liquidity has two inputs: the quantity of money in the system and the price of money, which is interest rates. So interest rates and the quantity of money in the system. So if you just think about it in a very simple term, two inputs into that would be like the Fed's actions in moving interest rates. And then the quantity of money in the system would also be something like the amount of money they have on their balance sheet. Now, there's a lot of other things that determine the amount of interest rates or the level of interest rates and things like that in the system. But overall, when you have high levels of valuations, the system becomes a lot more sensitive to changes in macro liquidity. And that is one of the things that is what a lot of people are not really focused on right now. What most people are focused on is the entire AI capex side. And here's the thing: that's an important side to focus on. The chart right here that I wanted to share with you is that the beginning of compute financialization is happening. Nvidia proposed a deal to marshal over 500 billion of capital for data center risk, excess capacity for AI compute being added, ultimately leading to a bust, or that's what people think. Nvidia's aim is to turn AI factory compute into an investable asset class by helping ensure the residual value of GPUs used to power data centers. So, if you're trying to understand residual value of data centers, if you go to, actually, I think I already covered. Let me pull up the report really fast. These guys, AmericanCompute.com, they are probably the best spot to read about residual value for GPUs and how the entire market works. They, the entire, guys that are working on this, really good. I think that they're doing an incredible job, not only educating people, but being able to pull everything together on the infrastructure side. And you can go through their reports. We went over these reports in a recent stream. And the entire idea is that the GPU market is broken down into several spots. But what you can do is go to their blog. They have articles that they're publishing like every month almost. And no, I mean, to my knowledge, I mean, maybe there's a couple people here and there, but there's no one doing so many reports. I mean, they just have so many reports that are actually breaking things down. They kind of talk about the risks for AI and how to think about the underwriting opportunity, as well as, a lot of people have talked about how a lot of the private credit and debt and things like that roll over at the beginning of 2027. That also can overlap with some of these risks around the IPOs. And, we haven't really seen a true shock to the system on the GPU side at the end of the day. When you look at the Nvidia chart, and let me pull that up. Broadly speaking, Nvidia has not had anything super crazy happen to it. When you look at this chart, all of the pullbacks that have happened have not really been connected to the fundamentals of Nvidia. I'll actually pull up the chart for where the returns for Nvidia are coming, because that will really, depict everything a little bit more. But when I look at Nvidia as a company, if the pullbacks that happen are driven by fundamentals, then I'm not as worried. Come on. Here we go. Okay, so here's the changes that we have seen in Nvidia, the rolling returns, and we'll even go back, 20. We'll actually go to the price right here. You can see ever since, we'll go back, we'll set the look back at like 5 years, 2021, because this whole period right here was when they had their really big run. Now, here's the thing that people are not going to dig into as much, but this will connect to why the market's acting the way that it is. If you look at the changes that have taken place in Nvidia, the majority of them have on the downside have been connected to market returns, not fundamentals. So for example, when you look at, and I need to overlay this a little bit better so that you guys can see it. But for example, once we begin to move into 2023 is when Nvidia starts to really rally in 2023 and 2024. So that is in this period of time. What you can see is that it's primarily from sector returns at 32% contribution, and then 25% contribution from fundamentals during this period of time right here. And then on the downside, overall, you have on the downside, you actually have fundamentals contributing in a positive way. And then you have the market being the negative factor, the negative contributing factor on a pullback. And then overall, you see right here, in 2024, into 2024, beginning of 2024, it's up 75% on a rolling 3-month basis. The market's up 9. The sector is not really contributing anything. So when you look at any of these times when it goes negative, it's primarily because of the market and the sector, not the actual company itself. And so even right here, more recently, when we look at kind of the rolling returns and things happening right here and some of these pullbacks, Nvidia is not underperforming the S&P 500 or the semiconductor sector in a massive way. There was some equity long short positioning where Micron took some capital from Nvidia for a little bit, but broadly speaking, Nvidia, we haven't had a true scare based on the fundamentals. All of these moves, and you'll see this really clearly if I overlay the two. If you overlay the S&P and Nvidia, it is abundantly clear that these pullbacks are due to the market, not the fundamentals of Nvidia. And if you overlay other companies or sectors, for example, if you overlay XLRE, you can see there's way more divergences, way more issues. So for example, you have divergences on the upside, and then you have divergences on the downside right here. And then if you look at other sectors like XLC, you can see that that's diverged on the downside. It went up on the upside, and then I believe on XL, yeah, right here you have XLV diverging on the upside, and then on the downside right here, same thing right here, and then this is a clear one where you have XLB literally moving down as equities are moving up. These are all indications about fundamentals in the sector, right? And if we went into specific names, you would see that even more clearly. But when we talk about Nvidia itself, we haven't had a true shock to the underlying. And that's why understanding these ideas of the residual value and these new changes that we are seeing in the system are very important. And this idea of, okay, we're having compute financialization. By the way, I think that if you can own the financialization market for an asset and not just the asset, then you're basically double dipping in the entire monetization process of your product. Because most people, think about it, they let other people take care of the markets for them. But Nvidia, they actually want to own the product and the transactions around that product, which is just going to make them more of a monopoly. And so, especially with, it's kind of like how the U.S. dollar, or so the U.S. Government has the U.S. dollar, and they're like, oh, well, if we run out of dollars, we can just print more. Nvidia obviously has some constraints on just printing GPUs, but think about it. They actually have the ability to just create more and be like, oh, we're missing this. We don't really want a credit event. We'll just guarantee those for in 2 years and you guys will get them. Right. And they can, be able to warehouse risk in a way that a lot of other people couldn't. So I think this is something that people are watching a lot. And I think rightfully so, because if you look at the returns for this sector, and you are sorry, the returns for the S&P 500, and you look at them, let me pull it up here. So if we look at, let's just say 6-month returns, because we're almost halfway through the year, or we're over halfway through the year. What's been the largest contributor for returns over the last 6 months? And the answer is it's been primarily on a weighted average basis over the last 6 months. The S&P 500 is up 20% almost. 11% of that is from tech. 2% is from financials. By the way, we talked about this yesterday. Like, if you really think that the economy is collapsing when financials are making all-time highs, that's, basically a direct contradiction of like what you're thinking right now. Um, and so, you have healthcare, industrials, consumer discretionary, but who is the main player? It's all information tech, all on the tech side. And you can see these bars right here showed the weighted average contribution of each sector, and everything is coming down to tech. That's why so much in the equity side is a one-way trade. Now, all of us know that tech is driving the market. If you talk to anyone at a hedge fund, talk to anyone at equity long short shop, anyone in the prop space, anyone just trading themselves, all of them know this number. That's easy. The problem is that everyone is so focused on this side of things, of the GPUs, of Nvidia, and everything like that, that they're not focused on this bigger question about macro liquidity. And, macro liquidity is one of the most important factors for two different sections. And, on the chart that I started with, because I think this really depicts a lot of it, um, you know, the valuations of these of the index right now is really elevated, and a lot of that connects to one, interest rates are not restrictive enough relative to the amount of capex growth taking place in the economy. So that's just, if people say like, oh, interest rates are impacting the everyday person and they're destroying people's lives and things like that, it's just not true. If you look at the underlying data, it shows that exact thing, that like consumer is totally fine right now. All it is people, on social media extrapolating a single data point. But when you look at, I'm going to pull this up right here. When you look at valuations that are this high in the system, I think that begins to frame that uh, any changes in macro liquidity can have a really big impact. So, if I just kind of give you a conceptual kind of idea of this, the macro liquidity, let's say it moves by on a scale of 1 to 10 in terms of like a 2, it contracts by a 2. Overall, in a normal period of time of medium to low valuations, that's not going to have a big impact on equities. But when equity valuations are really high, you can have macro liquidity move by a 2 or a 3, and you can have a 10% move in the index on either direction, just because everything in the base of money is so excessive. That's why, one, you want to understand interest rates really well, because we did a whole video yesterday on this. But the quantity of money in the system is directly connected to cross-border flows, which directly connects to the yen, Kevin Warsh, Scott Bessent, and I think it is pretty ironic that everyone, this is the entire article that I wrote on this idea, and I would encourage everyone to go double check it and reread it. But this tweet by or this note by Scott Bessent, I mean, this is what he writes, right? This is the note that he put out, that, oh, to-do lists while he's like doing things. Buy the Japanese yen, 5 to 10 billion. And people saw that, and what they do right away, they just thought like, oh, don't don't bet against the treasury, don't bet against the Federal Reserve, don't bet against this, don't bet against that. When in reality, if you look at the underlying system and you understand the drivers of things, the yen has only collapsed. I mean, Scott Bessent wrote that basically like right here. and we have only moved over since then. So you have to know when to bet against the Treasury and the Fed. I mean, this idea of like never bet against the Fed is like so arbitrary. Like, what does that mean? On what time horizon? Like, I've made so much money just knowing when to take the other side of the Fed and knowing when not to, because again, the carry trade is one of the key things right now. You can even see this with Aussie yen right now and how it's moved up, how excessive this has been, and how much of the entire market is connected to these flows in the carry trade. So, in terms of the quantity of money in the system, Aussie yen, the peso against the JPY, I've been talking about this for a while. As long as these keep moving up, capital is moving out the risk curve. That's super clear. The question is, it doesn't matter if the Fed does anything. If the carry trade, which is a cross border function, it's about international flows. If the carry trade unwinds, it doesn't matter how well CapEx is going. It doesn't matter how well Nvidia earnings are. Valuations across everything can fall and can decrease pretty significantly. If you don't remember, this right here was the carry trade unwinding. And if you look at the Nikkei during this period of time, it led to the downside. And we've talked about this extensively. You know, when you have the carry trade unwind and these moves like this, especially against the yen, whoops, and here's Aussie yen, you can just see it moving in lockstep and it pulls the Nikkei down so much, especially the Nikkei. I mean, like I'm waiting on the Nikkei right now. I think there's going to be a massive bet short in the Nikkei eventually, not right now because the carry trade is not unwinding. But you have to realize it, and and James, you can kind of speak to this because this is in the Asia session where people don't really expect these massive moves. I mean, the Nikkei has been the largest performer of everything. I mean, look, like year to date, the Nikkei is up 36%. It's insane. 36%. We're not even talking about the main stocks in the Nikkei. And then over the last like year, 70% almost. But you can just see right here, this is when the carry trade unwound. Notice from peak to trough, 27% drawdown in an index. And then it whips back up to down 8. Just because the Nikkei is so much less liquid than the S&P, there's so much less financialization in some of these markets. And so being able to trade these, I mean, by the way, these are getting more efficient. Even right now, like I've even seen how aggressive some of the algos are and how more efficient they are in the Nikkei now. Even with like things on the way down right here, you can just see like how this, and again, we didn't have the carry trade unwind, but you can just see these reversals right here where you reverse the entire day's price action. Same thing right here. And then, like you see the same thing like right here. Like this is people coming in and getting their fill, but they're not setting a bottom. And a lot of people, oops, right here. So when you have these aggressive moves, a lot of times you'll think like, oh, that just created a bottom. Let me get long. And then, you reverse and then it, basically washes that out again and again and again. And this is why you want to know the macro drivers of a situation, the sector flows and things like that. And also why it's super valuable to know what the curve is doing. And, the the thing that I want to pull together for this side is actually I have this in my, let me go right here really fast. But on the Nikkei side, if that happens, it's all going to be in the Asia session. And James, you can kind of speak to that a little bit on like trading in the Asia session, very very different than trading the US session, especially when you're trading the Nikkei or US assets or something like that. It's just a very different dynamic.
Yeah, I mean, it'd be really interesting actually to see this play out where the some of the bigger moves could actually start when everybody's not paying attention, right? Like they could start at 6, 7, 8 p.m. and create. I mean, I guess everybody is used to seeing that with like the what is it, the topics or whatever,
Yep.
or the Korean market just going crazy overnight. But if it starts to bleed in the Nikkei in these overnight sessions, there's been some people who've done studies about like the returns of like the stock market in the overnight session compared to the daytime session. And it's definitely something you want to start to think about if we find ourselves in these situations. Are you prepared to execute in the evening? Do you have a vector to act through with liquidity available to you? Because you're going to need to be able to move. There's going to be opportunity overnight as well. And I've started to do that more. I've started to kind of get back into the cadence of looking at the opens at 3 and 5 p.m. on the West Coast and kind of seeing if there's any movement and being there pre-market. So illiquid or not or less liquid, I should say, you can start to see if it's bleeding over into our stocks and ES, and um, there could be some signal there coming up since we're paying a lot more attention to Nikkei and JP JPY and stuff like that. And actually, if you take a look at this is pretty wild. Besson actually posted this too. Have you seen this one? It's kind of weird. It's wild to me that he kind of knows who you are. Do you see
What is
that?
it?
What does that say
It's
on
not
there?
big enough.
Oh, it's not? Oh, that's wild. I've heard that before. Hold on. There you go. Can you see it?
Traded extremes and meme in between.
There you go. So we'll see what happens here in the overnights, but it's something I'm starting to watch a little bit again.
Yeah, I like it. I like it. Back on, for the Japanese markets right now, over the last 20 days, you can see we've had the Nikkei up, rates up, and then the Japanese currency up as well. We're still up over the last 20 days on the Nikkei. I'm sorry, on the yen. And you can see that right here. So, the overall covariance has not increased that much. Covariance across everything is dropping right now. So you see this purple line, that's the covariance between asset markets. That tells you a lot. It tells you that whatever the impulse is, you're like, just think about it like this, is like if you have a shock to a system, and if that shock is big enough and pervasive enough, it'll impact interest rates, the currency, and risk assets. Sometimes you'll have shocks here and there. It's like, oh, an inflation print, no big deal, we'll shake it off. Oh, some credit risk, no big deal, we'll shake it off. Oh, some currency intervention, no worries, we'll shake it off. That's the period of time that we're in right now. We're just kind of shaking off everything. But when the covariance rises, which just means the correlation between things. So correlation is between two items, two variables, the Nikkei and interest rates. What's the stock bond correlation? And then the covariance is between three things. When the covariance between assets is increasing, that means you have something that's feeding through the entire system. Right now, the covariance is dropping, which is almost like market breadth dropping. And if you look at that across the United States, very similar thing taking place, actually. Covariance has been dropping. If you look at it across the UK, it's actually increasing just a little bit right here, as you have, not a ton, but a little bit, as you have the pound falling, and then the FTSE is still rallying, and then gilts are basically flat. If you look at the Eurozone overall, which, why are we looking at the Eurozone right now? Sometimes I ask myself the same thing. Why are we looking at a market where the people are not even, thinking about using AC? Hey, you know what? As long as we can make money trading it, we'll keep doing it. Okay. I'm not gonna make the rules here. Okay. I'm not gonna be prejudiced. Okay.
Imagine what are their like ideal market hours over there, like 8 a.m. to 9 a.m. and then they just go on
Oh, dude.
siesta.
Okay. I don't mean this in a bad way, but you not believe how many conversations I've had with people, like literally traders at hedge funds in like the UK, France, Spain, like Germany. Well, probably a little less Germany. It's happened a couple times. But just anywhere in Europe, I know people are like, ah, the UK is not there or whatever. But it's like the UK is not the same thing. But it's like, yeah, bro, it is. It's like all the same spot. I'll like talk to like these guys and they'll be like, I'll be like, oh yeah, you want to like work on some stuff together, like, you know, you want to like talk back and forth about these trade ideas and kind of figure some stuff out and like put on some risk or whatever, just like other guys that I know. And they're just like, yeah, mate, let's do it, like whatever. And then it's like I talk to them a week later and they're like, oh, hey mate, we're going on holiday for 3 months. I'm like, what? I was just like, what are you talking about? I was like, oh yeah, like, oh yeah, can we circle in 3 months? I'm like, what? It's like they want to just talk in 3 months, and I'm just like, okay, dude, go ahead and do your thing. It's just like it's wild, and they're just like it's like just a normal part of life. I know there's some Europeans in the chat. Don't worry, Americans dislike all foreigners equally, and all foreigners dislike Americans equally. Okay, so it all
And
evens
that's
out, guys.
just what makes the world work. You know what I
Yeah,
mean?
yeah. Don't try to change it. Just embrace it.
It is
Embrace
what
it.
it is. You guys keep thinking we shoot every kid at our schools, and we'll still think that you don't work 10 hours or 10 months of the year. There
Potato,
we go.
potato. Let's not
That's it.
let's not let's not get into the nitty gritty details. It's all details. It actually is funny. I think every single time I've had like a friend from Europe come over, um, or just from any other country, they're like, oh man, like we didn't get shot today. You're just like, what are you talking about? It's the land of the free, man, home of the brave. This is the greatest place. So
Don't worry.
uh,
We got you. We got you
yeah,
taken
we
care
got
of
it.
if you
We
come
got it.
over here.
So, um, here's the kind of thing that I'd pull everything together with for everyone on this idea of equities. You know, um, my entire model and strategy pulls together all these moving parts, and we're always talking about that in the paid subscriber section, updating it every single day. But broadly speaking, the biggest risk in the equity market right now is not the is not is the semiconductor credit side of things. It's actually the valuations, not just on themselves, not because valuations that are high are unsustainable, but because of interest rate volatility being so low. We've talked about this. And then also you have the carry trade and quantity of money in the system is beginning to put pressure on things. So think about it. The yen falling, if you look at, the yen and it's falling this entire period of time, basically this entire period, the yen has been getting devalued and this has funded the carry trade. Everyone has borrowed short and put up risk in US equities. And this entire thing represents how much leverage is in the system now in yen denominated leverage, basically. Doesn't it make a ton of sense why like you now have like Scott Bessent and other people trying to say like, oh, we realize that this is actually an issue. We're going to kind of like try to play a little bit of a game with it so that we don't, tip our hat. It's about helping the Japanese government. Yeah, okay. Okay. Sure. Sure it is. At the end of the day, Scott Bessent knows that the leverage in the system is directly linked to this entire change in the carry trade. And so, as long as this keeps moving down, that's going to keep injecting money into the system. But even if you have the yen pop up a little bit, not even retrace the entire move, but just pop up a little bit, that can have drastic impact on US equities, even a 10% drawdown or something like that. Now, my entire goal during this period of time is not to say like, oh, well, I should just be bearish and be on the sidelines. My entire goal is saying like, oh, well, if things are the way they are, how can I make money in spite of that? And that's one of the things that I've been talking about, and we've been going over in the trade section of the second half of the stream. So my entire goal is to not say like, oh, valuations are high. That means there's a lot of risk. No, All it means is that you need to understand these carry trade dynamics and US interest rates, especially 30-year interest rates, given what we are seeing with the CPI print, the PPI print today, and the auction, and things along those lines. Connect those to things like the covariance. I mean, the things like the curve bear steepening in the way that it is right now. So all of these moving parts are coming together right now. And in my view, when you begin to model them, especially the volatility and underlying drivers, you're beginning to see what we call the tails compress. It just means that the probability for an extreme move is increasing. That's even why we've had, you may think about it, on the upside right here for ES, just recognize that when I say, oh, the tails are compressing, we are literally seeing that in real time when we saw the VIX rally at the same time as ES rally. You can see this right here. We actually had S&P or when ES was up, and then you also had the VIX up right here through several days. Let me actually switch it to these candle bars so you can see it a little bit easier. Yet notice right here how you have vol is actually rising right here with the index. And then you have periods of, whoops, come on, periods of time, like right here, where the index melts up even more. This large move that took place in the index, and then vol rose right here and spiked up at this high. Now we've been in this range. We've kind of had a lot of the theta decay get unwound. And now the question is, okay, well, we just made a new high. How sustainable is that on a short term basis as the VIX is down here? And that's what we're going to kind of dig into in the next section. So,
That was kind of a fortunate outcome, by the way. Like, I kind of feel
oh,
like
yeah.
that
Oh, yeah.
move right there is like the most fortunate you could have, where it just cools off just a little tiny bit, VIX stops ripping, and then everything falls back into place. You can keep climbing. So
Yeah, this is like retrospective bias at its finest because it's very possible that, like, especially with stuff like this, where like VIX is popping and then especially up like this, where it's like rising as the index is rising right here. Like, this is just pure short covering and hedges getting cooked, especially up right here, right? Like, this could have ended really badly. But no one's going to talk about that. They're just like, oh, no, it doesn't matter. Like, this could have ended down here and back down here, and then we would be making a rally up or something like that. But these are all like little signals that if you're not watching, or if you don't see, or if you don't just retrospective bias everything, like, it's going to be important to watch, because like, I would not be surprised if we are going to see another day where VIX is up and S&P is up, especially in this regime that we have with very low correlation between equities and rates and equities and FX. So those are all going to be really key things to think about. So those are the main ideas for the free section of the stream today. We're going to dig into them deeper and go over several other ideas that I really want to talk about in the paid subscriber section. So if you guys have questions, you want to go through any of that, everything will be linked below. If you guys just go to Capital Flows Research, you guys can go to the second half of the stream if you guys want. And with that, we will see you guys on the other side. Bye.